CEO Carlos Tavares noted that the strong focus by employees on operational excellence and synergies execution led to achieving very strong H1 financial results.
The U.S. auto market is spiraling into chaos, and Stellantis just lit the fuse. The parent company of Jeep, Ram, Dodge, and Chrysler has flipped the industry on its head with massive, unprecedented discounts that no one saw coming. These aren't small price cuts. We're talking up to 20% off on new trucks and SUVs, and even deeper dealer-level incentives to move metal off the lots. Something this big doesn't happen by accident. Stellantis isn't just offering a sale. They're signaling a desperate survival move in a collapsing market. So why now? Well, Stellantis has been sitting on a mountain of unsold inventory for months. Dealers are stuffed to the ceiling with Ram 1500s, Jeep Grand Cherokees, and Dodge Durangos that just won't move. Interest rates are still sky high, car loan delinquencies are breaking records, and consumers are simply done paying $70,000 for trucks. Stellantis executives know this. So, instead of letting inventory rot, they're slashing prices to spark a buying frenzy before it's too late. But this isn't just a pricing strategy. It's a wake-up call for the entire US auto market. Because when one of the biggest automakers on earth throws in the towel and starts discounting heavily, every competitor, from Ford to GM to Toyota, feels the shockwave. It means demand is collapsing faster than anyone wants to admit. It means automakers are no longer in control. Buyers are. And for buyers, this could be the moment they've been waiting for. Trucks, SUVs, and muscle cars that were completely out of reach last year are suddenly affordable again. Some dealerships are even stacking rebates on top of manufacturer incentives, so that brand new Ram 1500 sitting on the lot might be going for the same price as a used one from 2022. For consumers, it feels like the first real break in years. But here's the catch. These deals might not be as sweet as they look, because even though Stellantis is cutting prices, interest rates remain brutal. That means your monthly payment could still be higher than you expect. And if these discounts are a signal that automakers are panicking, you have to wonder, what happens next? Will more discounts follow? Or are we about to see the auto market crash even harder before prices truly stabilize? Meanwhile, Wall Street is watching this situation unfold with pure anxiety. Stellantis' aggressive price war might help short-term sales, but it's also slashing profit margins to the bone. Investors are asking, if Stellantis has to discount this deeply just to move vehicles, how weak is demand really? And if demand is this weak for Stellantis, what does that mean for Ford, GM, and Tesla? Stock prices across the auto sector have already started wobbling, and analysts are warning of a coming earnings bloodbath if this discount war spreads. And it's not just about car sales, this has ripple effects across the entire economy. Auto loans make up a massive share of consumer debt, and if values crash, lenders and banks are exposed too. Every truck sold at a discount chips away at resale values, creating a downward spiral where used cars lose value faster and new car prices have to drop even lower to compete. It's a full-blown deflation loop, and Stellantis just kicked it into overdrive. But behind the scenes, there's another reason Stellantis might be making this move, and it's not just about clearing inventory. Stellantis is gearing up for something massive, a complete transformation of its US lineup. With electric trucks, plug-in hybrids, and next-generation EV platforms on the horizon, the company can't afford to let thousands of unsold gas-powered models sit around. The 2025 Ram REV, the electric Dodge Charger Daytona, and Jeep's new wave of hybrid SUVs are all waiting in the wings. That means Stellantis needs to clear space, fast. And what better way than to dump old inventory at fire sale prices before the new wave hits? This isn't just a clearance. It's a strategic reset. Stellantis is playing a dangerous game, trading short-term profit for long-term positioning. They're signaling to Wall Street that they're ready to pivot hard toward electrification, even if it means losing money now. But this gamble could either save the company or sink it. Because while Stellantis tries to reinvent itself, every deep discount undermines consumer confidence in the brand's current lineup. Buyers start thinking, if prices drop this much now, why not wait a few more months for an even bigger discount? That hesitation can freeze sales even further. And that's exactly what's terrifying rival automakers. Ford and GM are already fighting softening demand, rising costs, and slowing EV adoption. Now Stellantis has just opened the floodgates, forcing everyone else to either match their prices or lose customers overnight. That's why you're seeing aggressive financing deals, longer loan terms, and more cash incentives popping up everywhere. What started as a Stellantis problem is quickly turning into a full-blown price war. Dealers, meanwhile, are caught in the middle. Some are celebrating the discounts because traffic is finally returning to the showrooms. Others are furious because their profit margins are evaporating. Many are reporting that Stellantis' incentives are erasing dealership holdbacks and bonuses, leaving them to move vehicles just to stay afloat. This kind of turmoil hasn't been seen since the 2008 financial crisis. And back then, we all know what came next: bankruptcies, bailouts, and industry-wide resets. But here's the twist. While US automakers are slashing prices, foreign brands are quietly watching and waiting. Toyota, Honda, and Hyundai aren't diving headfirst into this price war, at least not yet. They're maintaining their margins, keeping inventory lean, and preparing to swoop in once the dust settles. If Stellantis, Ford, and GM burn too much cash in the coming months, the Japanese and Korean automakers could walk away as the real winners, capturing market share without joining the bloodbath. Yet the biggest wildcard in all this isn't even the automakers. It's the consumer credit crisis brewing underneath. Subprime auto loans are defaulting at the fastest pace since 2009. Lenders are tightening requirements, repossessions are surging, and the used car market is collapsing in real time. Stellantis knows that if they don't move vehicles now, they might not be able to move them at all later. So this wave of discounts isn't generosity, it's survival instinct. The company is trying to convert metal into cash before credit markets freeze completely. And when you see Stellantis offering thousands off across nearly every model, that's not marketing. That's panic disguised as opportunity. But as this meltdown unfolds, the real question becomes, how far will it go? If Stellantis keeps cutting deeper, will Ford and GM follow suit? And what happens when Wall Street realizes that the strong auto recovery everyone was banking on might have just been a mirage? Because the truth is, this isn't just about Stellantis anymore. It's about the collapse of the entire pricing structure that's held the auto industry together for years. For decades, carmakers relied on predictable margins, stable financing, and steady consumer demand. But now, that entire formula is falling apart in real time. Cars that were selling for $60,000 just a year ago are suddenly being listed for $48,000 or less. And even those aren't moving fast enough. The market is flooded, credit is drying up, and buyers have finally hit their breaking point. Stellantis' move is the domino that everyone's been waiting for. The one that exposes just how fragile this whole system really is. Once one giant slashes prices, the rest can't stay on the sidelines. Because imagine being a Ford or GM dealer trying to move a $65,000 truck when the lot down the street is offering a Ram for 10 grand less. Customers don't care about loyalty anymore, they care about survival. They're stretched thin by inflation, by rent, by interest rates, and Stellantis just gave them a reason to walk away from overpriced vehicles everywhere else. This sudden power shift, from automakers to buyers, is something Wall Street absolutely hates. Because it means manufacturers lose control over pricing, profits evaporate, and investors start to panic. We've already seen analysts warning that if these deep discounts continue into next quarter, Stellantis' profit margins could fall below 4%, a number that's dangerously close to red territory. And once that happens, you can expect a brutal chain reaction: layoffs, production cuts, and possibly even plant shutdowns. Yet Stellantis seems to be betting on one thing: volume over margin. They're trying to flood the market with sales, hoping to make up lost profit through sheer scale. It's a high-risk strategy that could backfire instantly if consumer demand doesn't respond. Because if they discount heavily and still can't sell, it won't just be a financial problem. It'll be a credibility crisis. Investors will start to question whether Stellantis can compete in a new era of affordability and electrification. But here's the really dark side. This could drag the entire market down with it. Used car values will fall faster than ever, leaving millions of Americans upside down on their loans. Banks will tighten credit even more, dealers will get squeezed, and automakers will face a shrinking pool of qualified buyers. It's a slow-motion crash that could take years to recover from. And while all this chaos unfolds, Stellantis is trying to send another message, a message to regulators, unions, and even competitors. We're not afraid to play hardball. The company's European divisions have already seen massive restructuring, and whispers from inside the US arm suggest cost-cutting measures are coming next. Executives are reportedly reviewing everything from labor contracts to EV development budgets, looking for anywhere they can conserve cash. Meanwhile, the United Auto Workers are watching this with fury. They just fought for record contracts, and now Stellantis is acting like it can't afford the costs. If sales slide further, it could trigger another showdown, jobs versus survival. And that's where things start to get truly explosive. Because if Stellantis begins trimming its US workforce, it won't just be a company story anymore. It'll become a political one. And that's exactly what has Washington nervous. Lawmakers know how fragile the post-pandemic auto industry really is. If one major automaker falters, it won't just affect car buyers. It'll hit parts suppliers, trucking companies, small-town dealerships, and entire local economies. We're talking about hundreds of thousands of jobs on the line. But while Stellantis seems to be bracing for impact, there's another theory brewing in financial circles, one that suggests this meltdown might not be a sign of weakness, but a calculated move to prepare for something even bigger on the horizon. That theory goes like this. Stellantis isn't panicking, they're positioning. The company knows the US auto market as we know it is dying, and they're using this downturn as a reset button. While everyone else scrambles to save short-term profits, Stellantis is clearing the board, dumping internal combustion inventory, securing cash, and gearing up for the next era of mobility. Insiders say the real goal isn't just to survive the storm, it's to own the market once it resets. Because make no mistake, when the dust settles, the companies that control cost, supply chains, and EV technology will dominate. Stellantis knows it can't outspend Tesla or outbrand Toyota, but it can undercut both with scale and aggressive pricing. That's why these discounts matter so much. They're not just about moving trucks, they're about reshaping consumer psychology. Stellantis wants Americans to associate its brands, Ram, Jeep, Dodge, with value again. They're betting that once the price war begins, they'll be the ones dictating the new price floor. But that's a dangerous game, because while Stellantis is slashing stickers, their competitors are cutting jobs, halting production, and freezing projects just to stay alive. GM recently slowed down its EV investments. Ford scaled back its F-150 Lightning output. Even Tesla quietly adjusted prices on several models after seeing demand soften. The entire industry is in retreat mode, trying to balance EV costs with collapsing consumer confidence. And Stellantis just shoved everyone off the edge faster. Wall Street's reaction has been brutal. Investors don't like unpredictability, and Stellantis just made the market unpredictable again. Shares across the entire sector are wobbling. Analysts are calling it the start of an automotive price collapse, and hedge funds are beginning to short auto stocks aggressively. The fear? That this isn't a temporary dip, it's the beginning of a deflationary spiral the industry can't escape. Because once consumers expect discounts, there's no going back. Buyers stop purchasing at full price, dealers can't hold inventory value, and automakers lose the one thing they need most: pricing power. That's the exact scenario that wrecked the American auto market during the 2008 crash. Back then, companies like GM and Chrysler needed government bailouts just to survive. And now, ironically, Stellantis, the company that rose from Chrysler's ashes, could be the one dragging the market to that same edge again. But Stellantis might not care about Wall Street's fear. They're looking past quarterly earnings toward market dominance. Insiders hint that Stellantis' European leadership sees the US market as overvalued and overleveraged, a bubble ready to burst. Their plan? Pop it early, take the short-term hit, and rebuild stronger. They believe whoever resets prices first will own the post-crash market. It's ruthless, it's risky, and it might just work. Meanwhile, everyday Americans are caught in the middle. Some are seeing their dream trucks finally within reach, while others are terrified their current vehicles are about to plummet in value. The used car market is already in freefall, with trade-in values dropping thousands in just weeks. And that's fueling even more pressure on automakers, who now have to compete with used inventory that's suddenly dirt cheap. Dealers are calling this the most chaotic market they've ever seen. One day, they're getting calls about rebates and bonuses. The next, they're told to expect more cuts because corporate wants volume at any cost. The message is clear. Sell now, worry later. It's short-term thinking that could save the quarter or destroy the brand's long-term value entirely. And while Stellantis races ahead, financial institutions are quietly sounding alarms. Auto loan delinquencies are soaring, repossessions are climbing, and lenders are warning that defaults could spike if prices keep collapsing. Because once vehicles lose value faster than people can pay them off, the entire lending system starts to buckle. But there's one question looming over all of this. What happens when these deep discounts stop working? What if Stellantis keeps slashing prices and the buyers still don't show up? What if this isn't a market correction at all, but the start of an auto industry reckoning that no one is ready for? Because if that's the case, if demand doesn't rebound even after these massive price cuts, then Stellantis might have just exposed a terrifying truth. The American consumer is tapped out. It's not that people don't want new cars. It's that they simply can't afford them anymore. Wages haven't kept up, inflation crushed household budgets, and interest rates have turned what used to be a $500 car payment into an $800 one. The math doesn't work, and Stellantis knows it. That's why these discounts feel less like marketing and more like a distress signal. And that's what's making Wall Street sweat, because if consumers have officially reached their breaking point, it means the entire post-pandemic auto boom was built on borrowed money and false optimism. Analysts are already whispering about a demand cliff, a moment when pent-up demand collapses completely, leaving automakers drowning in supply. Stellantis might be trying to get ahead of that cliff by clearing inventory before it hits, but the message their discounts send is devastating. If Stellantis can't sell at full price, who can? That's the domino effect nobody wants to talk about. Ford, GM, and even foreign automakers like Toyota and Hyundai are now forced to make a choice. Either hold their ground and risk losing market share, or join Stellantis in the race to the bottom. Neither option is good. If they hold prices, inventory piles up and cash flow evaporates. If they discount, profit margins disappear and stock prices tank. It's a lose-lose situation, and Stellantis just forced everyone's hand. Meanwhile, dealerships are being crushed under the pressure. Those who finance their lots with expensive floor plan loans are watching interest payments eat into every sale. Dealers who stocked up when supply chains were tight are now facing the nightmare scenario. Cars worth less than what they paid for them. And with Stellantis pushing discounts so deep, resale values are imploding. It's not just new car prices that are dropping. It's everything from 3-year-old Wranglers to used Rams and Durangos. This cascading collapse in value is about to ripple through the entire financial system. Banks holding billions in auto loans are already reassessing their risk exposure. Some lenders have started raising down payment requirements or refusing subprime applications altogether. Others are quietly offloading auto debt to secondary markets before the bubble bursts. If this continues, we could see credit tightening just as automakers need it most, a dangerous feedback loop that echoes the early signs of the 2008 crash. And while Wall Street panics, policymakers are scrambling behind the scenes. The auto sector is a cornerstone of the U.S. economy, from manufacturing and shipping to retail and financing. A collapse here doesn't just mean fewer new cars on the road. It means layoffs across assembly plants, trucking companies, suppliers, and even tech firms tied to EV production. The ripple effect could wipe out tens of thousands of jobs almost overnight. Yet through all this, Stellantis executives continue to project confidence. Publicly, they're saying these discounts are strategic, a move to strengthen customer loyalty and market share. But insiders are painting a very different picture. This is a controlled burn. Stellantis is willingly sacrificing profits now to survive a market implosion they believe is inevitable. It's like watching a company pull its own ripcord before the crash even happens. And here's the eerie part. Some analysts think Stellantis might actually be right. The data shows the cracks spreading fast. Inventory levels up, sales down, consumer credit weakening, and fleet demand shrinking. Even EV adoption, once seen as the industry's savior, is slowing under the weight of higher costs and lack of infrastructure. The market's hitting a saturation point. Everyone who could buy already has. Everyone who wants to buy can't afford to. So Stellantis' decision to discount deeply might not be a mistake. It might be a survival strategy for a market that's about to enter a long, painful reset. But what happens after that reset? When the dust finally settles and the price war ends, which companies will still be standing? And could Stellantis' gamble today actually be the blueprint for the next phase of the US auto industry? So here's the bottom line. Stellantis just forced the entire auto industry into a corner. Their massive price cuts aren't just discounts. They're a declaration of war. A signal that the market's overheated, that consumers are over-leveraged, and that the system is about to reset whether Wall Street likes it or not. What started as a few $1,000s off a truck could spiral into the biggest pricing collapse the US auto market has seen in decades. Buyers are cheering, dealers are panicking, automakers are scrambling, and investors, they're bracing for impact. Because Stellantis didn't just flip the industry, they exposed its weakest point. And as this storm builds, one question will decide everything. Will Stellantis' gamble save the company, or take the entire US auto market down with it? Because one thing's certain, this isn't the end of the story. It's just the beginning of the great American auto reckoning. If you found this breakdown eye-opening, don't forget to hit that like button, share your thoughts in the comments, and subscribe for more deep dives into the unfolding chaos in the auto industry. Stay tuned, because the next chapter might be even more shocking than this one.